Have you ever thought about investing in stocks but don't know where to start? Investing in stocks can seem intimidating, but with the right knowledge, you can transform your financial future. In this video, we will explore 7 essential lessons for beginners in stock investing. If you master these lessons, you will be well on your way to becoming a successful investor. Stay until the end to discover how each of these lessons can be applied to your life. Lesson 1. Understanding what stocks are. Before you start investing, it is crucial to understand what stocks are. A stock represents a small part of a company's ownership. When you buy shares of a company, you become a shareholder and own a part of the company. The first thing to understand is that stocks are divided into 2 main types: common stocks and preferred stocks. Common stocks give you the right to vote at shareholder meetings and receive dividends, which are portions of the company's profits. Preferred stocks generally do not offer voting rights, but have priority in dividend distribution and repayment in case of the company's bankruptcy. To understand better, let's use an example. Suppose you buy 100 shares of company XYZ at $10 per share. This means you invested $1,000 in the company. If company XYZ performs well and the stock price rises to $15 per share, your investment is now worth $1,500. If the company distributes a dividend of $1 per share, you will receive $100 in dividends. Furthermore, it is important to understand how stocks are bought and sold. Stocks are traded on stock exchanges such as the New York Stock Exchange, NYSE, or NASDAQ. You can buy and sell stocks through a brokerage. Many online brokers facilitate the buying and selling process, often with low or zero fees. Lesson 2. Opening a brokerage account. The first practical step to start investing is to open a brokerage account. Brokers are intermediaries that facilitate the buying and selling of stocks. There are several online brokers offering investment accounts, each with their own fees, platforms, and resources. To choose the right broker for you, consider the following factors. 1. Commission fees. Some brokers charge commissions for each transaction. Look for brokers that offer low or zero commissions. 2. Trading. Platform. Check if the platform is easy to use and offers the tools needed to analyze and trade stocks. 3. Research resources. The broker should provide access to research, analyst reports, and charting tools. 4. Customer support. Ensure the broker offers good customer support to help with any issues that may arise. After choosing a broker, you will need to open an account. This usually involves filling out an online form with your personal and financial information. You will also need to provide identification documents to verify your identity. Once the account is open, the next step is to deposit funds. Most brokers allow you to transfer money directly from your bank account. Once your account is funded, you are ready to start investing. For example, if you choose Robinhood, you can open a commission-free account. The platform is intuitive, and you can start investing with just a few dollars. After setting up your account, explore the platform to get familiar with its features, such as stock charts, market news, and watch lists. Lesson 3. Portfolio diversification. One of the most important lessons for new investors is portfolio diversification. Diversification means spreading your investments across different assets to reduce risk. Instead of putting all your money into a single stock, you invest in multiple companies from different sectors. The idea behind diversification is that if one company or sector performs poorly, your other investments can offset those losses. For example, if you invest only in technology companies and the tech sector suffers a downturn, your entire portfolio will be affected. However, if you also invest in sectors like healthcare, energy, and consumer goods, losses in one sector can be offset by gains in others. Let's consider a practical example. Suppose you have $10,000 to invest. Instead of investing the entire amount in a single stock, you decide to diversify your portfolio as follows: $2,500 in tech stocks, Apple, Microsoft; $2,500 in healthcare stocks, Johnson & Johnson, Pfizer; $2,500 in energy stocks, ExxonMobil, Chevron; $2,500 in consumer goods stocks, Coca-Cola, Procter & Gamble; By diversifying this way, you reduce the risk of major losses and increase your chances of achieving stable returns. In addition to diversifying across different sectors, you can also diversify among different asset types, such as stocks, bonds, and real estate investment trusts, REITs. Lesson 4. Fundamental analysis versus technical analysis. To make informed investment decisions, you need to understand the two main approaches to stock analysis: fundamental analysis and technical analysis. Fundamental analysis. Fundamental analysis involves evaluating a company's financial fundamentals to determine its intrinsic value. This includes analyzing financial statements, such as balance sheets, income statements, and cash flow statements. Fundamental analysts also consider economic and market factors, such as the company's competitive position, its management, and macroeconomic conditions. For example, if you are analyzing company ABC, you would start by examining its financial reports. Check its revenue growth, net income, profit margin, and debt. If the company shows consistent revenue and profit growth over the years and has manageable debt, it may be a good investment. Additionally, you can calculate important financial metrics, such as the price-to-earnings, PE ratio, which compares the stock price to earnings per share. A low PE ratio may indicate that the stock is undervalued. Technical analysis. Technical analysis, on the other hand, involves studying price charts and trading volume to identify patterns and trends. Technical analysts believe that all fundamental factors are already reflected in the stock price and therefore focus on market trends. They use tools such as moving averages, Bollinger Bands, Relative Strength Index, RSI, and MACD, Moving Average Convergence Divergence, to predict future price movements. For example, if a stock price crosses above its 50-day moving average, it might be a buy signal. For new investors, it is important to learn and understand both approaches. Over time, you may find which method works best for you, or even combine the two to make more informed investment decisions. And if you like the idea of earning between $5,000 and $10,000 per month as extra income by creating simple videos for YouTube like this one, I have a complete and straightforward course that I developed for a single payment of $29,090. The link is in the first pinned comment of the video and in the About section of the channel, okay? If you're interested, just click the link to know more. But now, back to the content. Lesson 5. Investment planning and goal setting. Before you start investing, it is crucial to have an investment plan and set clear goals. Investing without a plan is like navigating without a map. An investment plan helps you stay focused and make informed decisions. First, define your financial goals. Ask yourself, why am I investing? Are you investing for retirement, to buy a house, or to build wealth over time? Your goals will determine your investment strategy. After defining your goals, determine your time horizon. If you are investing for retirement 30 years away, you can tolerate more risk. However, if you are saving for a down payment on a house you plan to buy in 5 years, you should be more conservative. Your risk tolerance is also a crucial factor. Are you comfortable with market volatility? Risk tolerance varies from person to person. Some investors prefer safety and stability, while others are willing to take greater risks for higher returns. After defining your goals, time horizon, and risk tolerance, create an asset allocation plan. Asset allocation involves dividing your portfolio among different asset classes, such as stocks, bonds, and cash. A well-diversified portfolio can reduce risk and increase returns over time. For example, suppose you have a moderate risk profile and a 20-year time horizon. Your asset allocation plan might be 60% in stocks, 30% in bonds, and 10% in cash. Review and adjust your asset allocation plan regularly to ensure it still meets your goals and risk tolerance. Lesson 6. The importance of patience and discipline. Investing in stocks requires patience and discipline. The stock market can be volatile and unpredictable in the short term. It is common to see sudden drops in stock prices due to economic events, political developments, or even rumors. However, history shows that the stock market tends to rise in the long term. Patience is essential to avoid impulsive decisions that can harm your investments. One of the most common mistakes investors make is selling their stocks during a market downturn out of fear of losing more money. However, these downturns are often temporary, and the market recovers over time. For example, during the financial crisis of 2008, many investors panicked and sold their stocks when the market plummeted. Those who held onto their stocks or even bought more during the downturn saw their investments recover and grow significantly. In the following years, discipline is equally important. This means sticking to your investment plan and not deviating from it due to emotions or short-term market fluctuations. Stay focused on your long-term goals and avoid making decisions based on news headlines or stock tips. An effective strategy for maintaining discipline is regular investing, also known as dollar-cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the stock prices. For example, you can invest $500 every month in an index fund. This approach reduces the impact of market volatility and ensures that you continue investing regardless of market conditions. Additionally, periodically review your portfolio and make necessary adjustments to ensure it is still aligned with your goals and risk tolerance. Patience and discipline are essential for becoming a successful long-term investor. Lesson 7. Continuously educating yourself. About investments, the world of investing is constantly evolving. New opportunities, strategies, and challenges regularly emerge. Therefore, it is crucial to keep learning and educating yourself about investments to make informed decisions and adjust your strategies as needed. One way to stay updated is to read books about investing. Classics like The Intelligent Investor by Benjamin Graham and Common Stocks and Uncommon Profits by Philip Fisher are must-reads. They provide solid foundations on stock analysis and investment strategies. In addition to books, follow financial news and market analysis through reliable sources like Bloomberg, CNBC, and the Wall Street Journal. These resources provide up-to-date information on the market and economic trends that may impact your investments. Attending online courses and seminars on investments can also be extremely beneficial. Platforms like Coursera, Udemy, and Khan Academy offer courses on stock analysis, economics, and portfolio management. These courses can help deepen your knowledge and investment skills. Another effective way to learn is to follow experienced and successful investors. Warren Buffett, Peter Lynch, and Ray Dalio are some of the most renowned investors who share their strategies and insights through annual letters to shareholders, interviews, and books. Studying their approaches and learning from their experiences can provide valuable investment lessons. Moreover, consider joining investment groups or online forums where you can discuss strategies and exchange ideas with other investors. These communities can offer support, advice, and different perspectives that can enrich your knowledge. Finally, do not underestimate the value of learning from your own experiences. Keep an investment journal to record your decisions, mistakes, and successes. Reviewing your actions can provide insights into your behavior patterns and help you continuously improve as an investor. Investing in stocks can seem intimidating at first, but with these 7 lessons, you have a solid foundation to get started. Remember that knowledge is your greatest ally and that patience and discipline are essential for long-term success. If you master these lessons, you will be well on your way to becoming a successful investor. Leave your comment below about what was the biggest lesson you learned in this video, like the video, and subscribe to the channel for more amazing tips on investments and personal finance. See you next time. See you there.